In this video, I'm going to teach you about one of the best tax deductions for business owners called the 20% Qualified Business Income Deduction, or the QBI Deduction. This deduction is great for small to mid-sized businesses that operate through a flow-through structure, and I'll teach you about when the deduction applies and when it doesn't, and what types of income you can apply this deduction to. I'll also talk to you about some limitations that might apply in some cases where if you make too much money, you can in some cases have a limitation or reduction in the deduction that you can claim. And also some types of businesses are subject to extra limitations that may apply when you're calculating your QBI deduction. At the end of this video, I'll talk to you a little bit about some planning opportunities where you can make sure that you are maximizing the QBI deduction that you are claiming for your business, and where you might be able to reduce or eliminate any kind of limitation. If you are subject to some of the limitations that apply on the QBI deduction, you can take advantage of these planning opportunities to still be able to claim some QBI deduction or be able to avoid any kind of limitation at all. So let's start with what is the 20% QBI deduction. So this deduction is just a flat 20% deduction on business income of a pass-through entity. We also commonly refer to pass-through entities as flow-through entities. So flow-through entities are single-member LLCs where you have one owner of an LLC that hasn't made any tax elections, like an S-corp election, for example. So that applies in those cases. It also applies to partnerships or S corporations. So most mid-sized businesses to small businesses are going to operate as an S-corp or in some limited cases a single-member LLC. So for most cases, most of our business owners are going to be able to claim this deduction. Keep in mind, it does not apply to C corporations. So if for some reason you have set your business up as a C corporation, you are not going to be able to claim this deduction for any income from that corporation. The corporation itself can't claim the deduction, and the C corp is not going to be eligible for the deduction when you take dividend distributions from your C corp. That also is not eligible. So also the QBI deduction only applies to net business profits. So it doesn't apply to certain types of income like salary income or anything that's paid on a W-2. So if you're a full-time employee that isn't a business owner, you don't get this deduction at all. It only is a deduction for businesses and their net income. If you're the owner of an S-corp, for example, and you have to pay yourself a salary out of the S-corp to satisfy those requirements, then that salary amount you have to pay yourself is not eligible for the deduction. But the net profits of your S-corp after taking into account your salary will be eligible. It doesn't apply to capital gains. So when you sell your business, if it's an asset sale, for example, and the company sells its assets or just otherwise generates capital gains, then that income that's characterized as capital gains is typically not going to be eligible for the QBI deduction. It doesn't apply to dividends or interest income either. The only exception to this is, and this isn't really related to business owners, but if you invest in REITs, in some cases, qualifying REITs the dividends from those REITs can sometimes be eligible for a 20% QBI deduction. That's a separate carve out that they made for REITs. But for purposes of business owners, any kind of dividends, like if you have a business that's a C corp, as I mentioned, that's not going to be eligible. And also any interest income that you earn is also not eligible for the deduction. So it's really only net operating profits of your business that is eligible. But otherwise, it's a pretty much, except for the limitations I'm going to talk to you about in the next slide, it's just a 20% flat deduction on those net profits. One thing I want to mention is that this is a recent tax law change. This came into effect after the Trump tax law changes a few years ago, and it is only temporary under current law. So right now, unless there's Congress acts to extend this deduction, which we really hope they will, because it's a great tool for business owners to incentivize us to start businesses. But if it doesn't get extended, then it will only be available through the end of 2025. So this is only available for the next few years. And unless, again, there's a law change, then this might go off the table and we may no longer get this deduction, which would result in business owners paying a lot more tax than they are right now in those years when this deduction sunsets and is no longer available. Now that we know what the QBI deduction is, I want to talk to you about two separate limitations that do apply. So these are the really big limits that could either eliminate completely or reduce the amount of QBI deduction that you can claim as a business owner. And the biggest one here is there are certain limitations if you make too much money. So if you're a single filer and your income's above $182,000, or if you're married filing jointly and your income's above $364,000, you could start to have a reduction or elimination of your QBI deduction. That is not always going to be the case. It just is that once you get above these thresholds, the calculation gets a lot more complicated and difficult. And if you are someone who is above these thresholds or close to these thresholds, I highly recommend you take my Tax Strategies for Business Owners course, where I dive into this more detail. And I also give you access to my great QBI model that I've developed, where you can calculate based on, your income, the salaries that you pay yourself, for example. Then you can see what your limitation might be. And you can also toggle things within the model to see where there might be some planning opportunities to avoid a limitation. So I'll talk a bit more about that in connection with the planning opportunities. But if you are someone who is close to these limitations or above them, I highly recommend you take that course so that you can get access to that model, because that's going to be invaluable to you to make sure that you don't have a QBI limitation and to see what opportunities you might have to avoid any kind of limitation. So one thing I'll mention here is that if you are above these thresholds, if your business is high in W-2 salary, so if you have a lot of full-time employees, or if you pay yourself as the owner a high W-2 salary, then you can avoid having any limit. So if you're heavy full-time employees in your business, then you might still not have any limitation, even if you are above these thresholds. However, if you're, similar to a lot of more modern business structures, such as like digital businesses, where you don't have any employees. So if you just have contractors and you don't have any full-time employees, and the only person receiving a salary is maybe you as the owner, then you could see some limitations. So they do allow you to avoid a limitation if you do have significant W-2 salaries. But if you don't have any full-time employees, then you might have a big limitation here that you want to watch out for. The other limitation that I'm just going to touch on briefly is for personal services companies. So we also commonly refer to these professional services companies. If you are a business that operates in any kind of, personal service type field, so if you're a lawyer, accounting firm, consulting, it applies to athletes and artists in some cases, financial planners, doctors, any kind of business where you're really relying on the skill of one or more of your employees, think consultants, for example, then you are a personal services company. And if you are above these thresholds listed here, then you are phased out completely. So you're basically not going to have a QBI deduction in most cases at all. And you just lose the ability to get the deduction. So if you're these come in quite quickly. So if you're over 232,000 as a single filer, or 464 as a married filing jointly, then you can see your QBI deduction completely wiped out if you are in one of these fields. The other thing I'll mention is that capital gains, if you have significant capital gain income as compared to your total taxable income for some reason, then you can also see a limit in your QBI deduction. So watch out in years where you're triggering really high capital gains. So if for some reason it's typically not going to be a common fact pattern, because you're really only getting the QBI deduction if you have net business profits. So, there's typically not a case where you're going to have very little taxable income but high capital gains. And the capital gains make up a large portion of that taxable income. But just keep in mind, if you're triggering just an abnormally high amount of capital gains, you could see a reduction in your QBI deduction for that. So that might be another situation where you want to take my course so you get access to my model so that you can model that. So let's talk briefly about some planning opportunities here that might apply. So let's say, for example, I am limited because let's say I'm an online business owner, and maybe I'm an e-commerce company, or for example, and I only rely on contractors. So I don't have any W-2 employees, and I'm making a ton of money because it's an e-commerce company. It's very successful. Maybe I'm making, $1 million plus net income a year, and I am going to have a limit, right? Because I'm not having to typically pay myself a lot as the owner, because I'm very passive with respect to my e-commerce business. And I have a limit because I don't have enough W-2 salary to justify me claiming a QBI deduction when I get above these income thresholds. So what can I do to plan around that? Well, there are situations. So typically, if you've ever watched any of my other businesses or understand tax planning, as a business owner, you typically want your W-2 salary as low as possible, because it is the worst type of income you can earn. Yes, you do have to pay yourself a salary to justify, you as an owner of an S Corp, you've got to pay yourself some salary to justify the activities that you do on behalf of the business. But from a tax planning standpoint, you want that typically to be as low as absolutely possible. However, this is the one limited situation where you might want to pay yourself more, because and again, this is where you're going to need my model and my tax strategies course to be able to do that. But you're going to want to see if there is a situation, this actually happens quite frequently, where you might want to pay yourself more money and be able to claim a higher QBI deduction. So you may want to actually increase your W-2 salary so that you're also increasing your QBI deduction, because that increase in your QBI deduction may outweigh the detriment of having to pay more payroll taxes. So I know this is getting quite complicated and hard to conceptualize when I'm just talking about it, but if you are someone who is, subject to this limit, you may want to consider paying yourself a higher salary as the business owner to increase your W-2 salaries so that you can increase your QBI deduction. Because if you do the modeling and it shakes out right, you may actually be better off on a net perspective on the total taxes you're paying. So you might pay more payroll taxes and get a higher QBI deduction that offsets that higher payroll tax cost. So it's very complicated. This is not something that you can do yourself. This is not something that your CPA can do. I highly encourage you take the tax strategies for business owners course I linked to below, get access to that model, toggle it to see if I pay myself more and pay myself this amount, what happens to my deduction, and you can figure out what's the optimal level of W-2 salary to pay yourself as the owner, or if you have a co-owner, to maximize the deduction that you can get and pay as little tax as possible. The other thing I'll mention is that if you're a personal services company, so this happens a lot. This has happened to me in the past because I am a tax lawyer. So I've operated, law businesses, I've operated accounting businesses, both of which, and consulting businesses, all of which would be subject to this limitation. And they're quite lucrative usually. So you're obviously most likely going to be above these thresholds, and you are going to just lose your QBI deduction. So what happens with those companies is that you want to look at trying to carve out different types or business lines or service offerings that you're doing. So in a lot of cases, for example, the consultants, when I used to do consulting, I found that a lot of my clients that were consultants were also doing content businesses. We're also doing educational type businesses, info products. So what we would do is we would carve those out into separate lines from the actual consulting work where they're doing consulting with a client, so to speak. And we would say, okay, we know the consulting line is subject to this limitation. And, we know we're not going to get QBI deduction on net income for our consulting business. But hey, these other businesses like info products and content businesses and the money we make on that, the net profits from that business are actually not personal services type work. And so those should be eligible for the QBI deduction. So you want to look at, if you are subject to this personal services company limit, you want to look at potentially carving out lines of business and what really are products or service offerings that you're doing. You want to try to segregate those in a way that you can say, okay, this is subject to the QBI limit for personal services companies, but this is not. So you want to try to get some QBI deduction on some piece of that and carve out that business that is eligible. So this was a quick overview of the 20% QBI deduction. Again, if you want to learn about this more, and if you are someone that's subject to potentially, having some of these limitations, I highly encourage you to take my tax strategies for business owners course, where I dive into this more detail and I give you access to my model that took me a very long time to build, and I think is a great tool that can help you make sure you toggle between different fact patterns and different numbers and see how you can maximize your QBI deduction. So hopefully you found this video helpful. If you did, please like the video and subscribe to our channel.